Welcome to Volatility Trading Strategies. So investing in the various volatility products that have hit the market in the last several years, it's very exciting stuff and it's definitely growing in popularity. Not quite mainstream just yet, but the trajectory of volume is heading in that direction. We've got billions of dollars in assets now in just a few of the more popular products, so the growth has been explosive, which is good to see. Now, I've done several dedicated videos already discussing these products, introducing some of the various volatility metrics that we track, as well as some potential methods of actually investing in them. But for anybody not familiar with the volatility space just yet, I'd like to take a few steps back today and just answer a very simple question. Why should we invest in volatility products? Let me give you my top 4 reasons. At this point, there's no shortage of articles online discussing reason number 1, and that is, of course, the potential for great performance. But I approach the volatility space differently than most. For me, all of my investment decisions are always filtered through the lens of diversified portfolio management. I'm not a day trader, throwing caution to the wind, chasing the highest rate of return possible. There's plenty of people out there doing that this year, and simply due to favorable market conditions, for many of them it's working out quite well. To each his own, of course, and I wish them the best of luck, but I don't personally believe that's a viable long-term plan. I view investing in volatility products as only one part of a diversified portfolio, so I'd rather not come out of the starting gates here trying to wow people with talk of exceptional gains. I feel like if I can give you a few other compelling reasons first, then when we do talk about performance, it's just going to be confirmation of what we already know. So let's circle back to that one later and talk about reason number 2, which is diversification. Oftentimes when investors think of diversification, they imagine a portfolio starting with a healthy allocation to equities. And then they branch out further to include international stocks, large cap, small cap, maybe some utilities and real estate REITs, throw in some bonds, both government and corporate, low yield and high yield, and then commodities, precious metals, and so on. You end up with a portfolio that on the surface may appear to be diversified, but the problem is, several of those things are also highly correlated to the stock market. So when there is a recession, many things follow the stock market down, and investors often find the value of their diversified portfolio drops a lot more than they're comfortable with. Now, short volatility through some of the inverse products like XIV or XIV, for example, they're also correlated to the stock market, and they'll almost certainly go down with it during the next recession. But a solid volatility strategy will include a healthy amount of cash positions. And it should also include the potential to move into long volatility products such as VXX and VXZ. These are highly negatively correlated to the stock market and may offer some true mathematical diversification during recessions. During bull markets, diversification is less important. But during bear markets, that's when you need it the most. And it can't just be a portfolio of things that look and sound different enough. It actually has to be quantifiable. And volatility trading strategies that include cash and long vol products may provide this. So reason number 3, harvesting the volatility risk premium. So what is the volatility risk premium, you ask? Great question. Essentially, it's a measure of the extra amount that investors demand in order to hold a volatile security. Because none of us know what's going to happen in the future, we need to be compensated for taking on the risk of unknown future events. It's the relationship between volatility risk and volatility beta. Now, there's a few ways to conceptualize or view this, but let's take a look at a 1-year chart of the S&P 500. You can see down below, this pink line is the 20-day historical volatility, which is the volatility that was actually realized over the previous 20 trading days. I drew that yellow line at 12%, and for the past 1 year, the 20-day HV of the S&P 500 has stayed consistently low, below this 12% line almost the entire year. The turquoise line below that is the forward-looking 30-day measure of implied volatility, and again we have a yellow line drawn at the 12% level. Notice how the 30-day implied volatility for the most part has remained much higher than the 20-day realized volatility. This is the volatility risk premium. We need to be compensated for future unknown events, and for the most part, implied volatility does remain higher than realized volatility. You can see out there to the right, the 20-day historical volatility is 6.7%. But the 30-day implied volatility is 9.9%. This is a significant premium. If we look at the same chart but for a 3-year time period, you can see that there are times when overpricing of implied volatility is justified. There's times when unexpected events or sell-offs happen and the HV20 spikes up. You can see one at the end of 2015 and into early 2016 there, and another one after the Brexit vote here. So there are times when the volatility risk premium justifies itself. That's when proper allocation sizing and conservative trading with plenty of cash positions comes into play. But for the most part, we do see implied volatility trading at a premium compared to realized volatility. Now, when you invest in stocks or bonds, you're not really capitalizing on anything other than price action, and of course dividends and coupon rates. But systematic, rules-based investing in volatility products may provide the best opportunity to directly harvest that volatility risk premium. Now, option trading is another one, of course, but volatility products may directly exploit this as well. Moving on to reason number 4, removing human error. Let's face it, we humans, we are emotional creatures. And something that can push us towards our most irrational self is either the fear of losing money or our greed and desire to make money. When we're further away from those two, everything's fine. But as we move towards those extremes, either exuberance or fear, many of us start making poor decisions that can be financially costly. But a solid volatility investing strategy, at least the way I do it, isn't based on personal market predictions. It's entirely quant-based. Now, it is true that I'm the one who designed the strategy, but that was years ago, done calmly and rationally without a whole lot of emotions. Just number crunching, data mining, and years of live testing. So at this point, aside from some changes along the way as the markets evolve, the system is in place and my trade decisions are out of my hands. It's rules-based and I just follow it as if I'm a robot. Every day I input a long list of data points, and then based on the levels and ratios of all the indicators, the strategy makes a determination of the best risk-reward position to be in, and I just follow it. I don't make decisions based on what I think will happen with North Korea, or whether the Fed does or doesn't raise interest rates, or whether people like or dislike President Trump. I have personal opinions, but I can't let those guide my trading decisions. In my opinion, one of the most important things for investors to realize is that none of us have a crystal ball that is much more effective than 50-50 in the long run. So systematic rules-based trading removes the emotional elements, and it's one of several things that draws me to volatility investing. So there's 3 reasons for potentially allocating a small portion of your investment fund to this exciting new world of investing in volatility, and they don't have anything to do with performance yet. Number 1 is the potential for true mathematical diversification. In a world where the outcome of many products closely follows the equities markets, this low correlation may be invaluable. Number 2, harvesting the ever-present volatility risk premium that isn't based on market predictions. It's essentially human nature itself. We nearly always overprice future unknown events, and knowing how to capitalize on this mispricing is possible when you directly target the VIX futures and the roll yield. And number 3, just removing ourselves and our emotions from the equation and sticking to the raw math. Sure, it feels great when you make a market prediction and it comes true. You feel like a genius. But what about all those times that we're wrong? If I had a dime for every article or video I've seen online saying so-and-so fund manager who called the top in equities, or this person who predicted the subprime crisis, I'd be a multimillionaire. It's funny though, I don't remember seeing articles or videos with people saying, hey, remember all those times when I predicted X and the exact opposite happened? I don't ever see those articles. So anytime we can remove ourselves and our emotions from the equation and just focus on the numbers, we're going to be better off. Now, do we even really need to mention performance? There's plenty of people out there talking about 30, 50, 75% a year investing in volatility products. And sure, the last 6 years have been a pretty good setup for this type of trade. I've been trading these products since the beginning, and it's been a lot of fun. But remember, when you adjust for inflation, the 20-year annualized return of the S&P 500 is only about 5%, and it's one of the better performers in the global financial markets. Do we really need to make 50% a year to justify a small portfolio allocation? I mean, given the potential benefits of diversification, harvesting the volatility risk premium, and removing ourselves and our emotions from the equation, I really don't even want to talk about performance today. So, in fact, let's just leave it right there. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.